And here we go.
Well, hello, everybody. Thank you for joining us today over this lunch hour for what I think is going to be a pretty fun and exciting webinar here. Um, Talking about a topic that I think gets misconstrued, gets overlooked, and just quite honestly doesn't get talked a lot about in terms of overall education. And that's how do we potentially unlock home equity when it comes to our retirement planning for what we would hope would be more optimal outcomes in our retirement journey. Um, there is over 16, I believe, $16 trillion in home equity right now. And about 50% of people today in America are going to go into retirement with a mortgage. And again, just the ability, the opportunity to have different tools in our toolbox to make sure that we are, you know, looking at all of them. And it might not be for everybody, and it might be not something you end up doing. But I think looking at it, especially as an advisor, I think I mentioned my name's Austin Thoms. I'm a certified financial planner and a financial advisor at Wealth Advisors Group here in Fort Wayne, Indiana, and helping people on their retirement journey every single day. And, you know, we look at Social Security, we look at pensions, we look at insurance, we look at investments. And I think when it comes to home equity, again, just over the years, it's been overlooked. It's been just not, we just don't know a whole lot about it. And back in February, I went to a work conference, and I'm going to introduce Harlan here in a second, but I went to this work conference in Orlando in February, and I sat in and Harlan and Cheryl and the Movement Mortgage team, and sat in their breakout session about how to use home equity to steward well what we've been blessed with, or something along those lines when it comes to retirement. I was hooked at the title, sat in it, and since then I've just been what I call a positive rabbit hole of wanting to learn more about this, be educated about it, so that as an advisor, I can be educating clients and prospects to the best of my ability when it comes to this topic. And so today, I think the number one goal is for you, whoever's listening to this or watching the recording, to walk away feeling more educated about this topic, learning something new, and then wanting to learn even more about it just outside of this time here. And so today I have a very exciting opportunity to bring Harlan Akala on here. Harlan is with Movement Mortgage, running the reverse mortgage department. He's a national expert on this topic. He has written a book, which we'll talk more about later, called Home Equity and Reverse Mortgages, the Cinderella of the Baby Boomer Retirement. And I've read it. It's incredible. And he's got people like Wade Pfau and Dan Hultquist and Jamie Hopkins. And I know Don Graves is doing a lot of work in this space. Very credible resources. And just super excited to have Harlan on today. Harlan, thanks for taking the opportunity to do this webinar with me.
Well, Austin, it's good to be here. I'm old enough to have a reverse mortgage myself, and has made it part of my family's plan. And fortunately, I've been able to literally help thousands do it for themselves. And it's a story that we just really want to try hard to get out, because the story that's out there in the mainstream simply isn't correct. And so we welcome any opportunity like this to be able to tell the truth.
Well, we're going to dive right in. I know we're kind of on a time schedule here, and we want to allow some time for question and answers here towards the end. So let's jump right in. And Harlan, tell us a little bit about yourself, your background, and how you got into this industry. And I think even more importantly, how you went from being a skeptic when it comes to reverse mortgages to now being one of the nation's leading advocates for it.
Yeah, that's 20 some years ago. I told people I was in the mortgage business back in the 90s, and I did traditional forward mortgages. I sometimes refer to forward mortgages. People say, what is that? Any mortgage that has a payment. And reverse mortgages are any mortgage that doesn't have a payment. So I was selling forward mortgages, doing refinances and helping people with purchases. A very noble thing. Helped a lot of people get into homes and everything. And every once in a while, the subject of reverse mortgages would come up, and I'd say, "Well, just stay away from those. They're a ripoff. They just they hurt the kids. They aren't good for the parents. It's just something to stay away from." And that's as far as I went until somebody challenged me and said, "Well, Harlan, what are they really? I mean, do you lose your house? And is that the deal?" And I started checking into it and talking to a lot of people smarter than myself, and my wife said, "Honey, quit saying that because that's a really low bar." But I did talk to a lot of really smart people that knew way more than I did, and just asked them, "How does this fit in?" And then I started. First, I never did anything without looking, what would this do for my family? What about my parents? What about my wife? What about my sister? Whatever. And when I started looking into it, I told my financial advisor, "Can you check it out?" I mean, I was in my 40s then. "Can you check it out as to how this would fit into my personal plan? Because maybe it's not that bad and maybe there's some legitimacy to it." And I quickly realized that if you just look at the numbers and take the emotion out of it, that a reverse mortgage makes a tremendous amount of sense. And all that a reverse mortgage is a mortgage that allows you to pay with your equity rather than with cash. So we know, and we're kind of beat into submission, so to speak, for 40 years. We're making a payment every first of the month. That's usually the first payment that we make on the first of the month. And that's what we must make a payment on to reduce the balance and pay the interest. At 62 years old, you can reverse that process, hence the name, and say, "I don't want to make mortgage payments anymore because I have it almost paid off or I have a substantial amount of equity. And now the future payments of interest, I just want to tack that on to the balance because my house is going up in value anyhow, and I want to make that payment optional." If you already have your house paid off, well, then you can just take money out and reverse the payments and have the payments being made to you rather than putting payments in. It's really not that much different, Austin, than what you do with annuities or stocks and bonds or mutual funds or IRAs or anything else. You put money in, and when you get older, you can take it out. All we're doing is turning a house into an asset that allows you to take money back out instead of just putting money in. And that is very counterintuitive because I was brought up on a central Wisconsin farm and I was just told you to pay off your mortgage as quickly as you can. And my goodness, I went to mortgage burning parties in the 60s. And so I was just told that's what you do. You just pay off the mortgage as quickly as you can because otherwise you can get in trouble and you can lose your house and all those other things. And so, not to belabor the point, but I'll refer to this on a regular basis. I'm not going to go through a PowerPoint presentation, but just showing this graphic because I was used to, milk pails as a kid. Bucket one, everybody who owns a house has three buckets of wealth. Bucket one is the client's ability to make money. Bucket two is everything you manage, Austin, from 401ks, IRAs, 403bs, stocks, bonds, mutual funds, ETFs, whatever. And that's money that I don't need today that I'm putting away for the future. Bucket three is what we work in the mortgage business every single day. And we help people create equity in their home by buying a house, making payments. The value of the house goes up, their payments or the balance of the mortgage goes down, and they end up with a bunch of equity. And as you mentioned, trillions and trillions of dollars worth of equity once people get into their 60s in my age group. So that's normal and all expected. But what people don't think about is the distribution phase. So, okay, when I get to be 62, I can start drawing Social Security if I wish, somewhere between 62 and 70. I can go walk into your office, Austin, and say, "Well, I gave you a bunch of money, so I'd like some of it back. I want some dividends. I want some income from the money that I gave to you." But people don't walk into our office at any mortgage company and say, "Hey, I want my money back. I gave you a bunch of thousands, hundreds of thousands of dollars. In fact, about 30% of my income for the last 10, 20, 30 years. I'd like some of it back." That's all a reverse mortgage does is allow you to take money back out of bucket three without a significant amount of risk. Excuse me. So it's really pretty simple. Excuse me, I'm sorry. It's really pretty simple. People make it complicated. You don't sell your house. You don't give up the ownership of your house. You have the house and it belongs to you and it belongs to your kids after you pass. It's just that you're using some of it inside. So if I have a $400,000 IRA and I use 100 of it, I still have 300 left. If I have a $400,000 house and I use 100 of it, I still have 300 left. So it just allows me to use some of that money in bucket three that formerly simply became illiquid and something that I could not use.
Yeah, I think there's a lot of great points there early on in this webinar. I think you hit on people are so focused on the accumulation phase of, stocking money away in their 401k and outside investment accounts and paying the mortgage. And then when it comes to retirement, kind of flipping the switch into distribution mode. And I think that's where this bucket number 3 that you're referencing with the home is just been, hey, you've done a great job paying down the mortgage, and maybe you don't have a mortgage, and yet it's sometimes in certain situations one of the bigger assets that people have. And it's, hey, how does this maybe fit into the equation again from a retirement income planning standpoint? Is where does it make the most sense to pull money from in a tax favorable way? And I think that's where you have to consider at least having the discussion of having this third bucket. You kind of mentioned on this too, but I just want to clarify. So the planning for this in terms of a reverse mortgage can really start probably in your 50s, 55, but you do have to be 62 in order to be eligible. You need to have a substantial amount of equity in the home. You need to plan on living in the home and staying in the home long term. And you also have to be able to maintain the home, pay the insurance, taxes, things like that. Is that correct? Or is there anything else I'm missing or misspoke there?
It is. The only thing I would say is you should really start planning on this when you first buy your home.
Okay.
Just like if you buy an annuity, or you start putting money into an IRA, you start thinking about what is it going to be like, and what is it going to be worth when I take it out, and what is it worth monthly, and so on. In fact, in some investment statements now they say this amount of money will give you X amount of dollars in income at 67 years old or whatever. So you want to think about the house the same way. Yes, you have to have a substantial amount of equity, somewhere between 50 and 70%, depending upon your age. So it's, if you owe 300,000 on a $350,000 house, you don't have enough equity to start taking it back out because you have to have more than 50% equity. In fact, a real simple way to communicate it, it's in my book too. My wife elbowed me really hard when I was snoring one night several years ago. And I just woke up instantly. I said, over 62, 50% equity, still making a mortgage payment in the middle of the night, because that's top of mind for me. If you're over 62 and you have more than 50% equity and you're still making a mortgage payment, you have to ask yourself why. That is the
Mm.
first scenario, the first thought process. But you're planning for that. I started planning at 43 when I learned about them and said, what if I don't pay off my mortgage and I give more money to my advisor? Which is exactly what I did. And I ended up being in a far better position at 62. So I didn't have my house paid off at 62 on purpose. That was part of my plan. But I started at 43 years old, but I had a substantial amount more money in bucket 2. And then I did my reverse mortgage the day after my 62nd birthday, and my payment went to 0. Because the reason you want to pay off a house is so you don't have payments. It's not that you want a whole bunch of equity. What good does equity do? You can't eat with it. You can't rip off a screen door and take it down to the grocery store and get groceries. You have to have cash. And so the goal is not to have a whole bunch of equity. And even from a Christian standpoint, there's nothing in the Bible that says we should try to end up having a free and clear paid off home at death. There's nothing about that. And so, but a lot of people think, well, that's the golden ticket to be able to pay off your house before retirement and then go into retirement with a free and clear paid off house and give it to your kids. That's not wrong. It's just very inefficient. And so, what you want to do and answer your question on the planning is look at this like any other investment. How much money should I put in my house? How should I pay it off? Should I get a 15-year mortgage? Should I get a 30-year mortgage? The answer is it's better to have a 30-year and pay the minimum and give more money to your investment advisor because you'll be better off long term. But you look at every decision you make with your house is going to affect bucket 2, which is why you're such a wise advisor, because a majority of advisors do not incorporate bucket 3 into their planning. They just look at bucket 1 and bucket 2, and your clients should be thrilled that you're looking at the whole picture, because you don't get paid extra to look at bucket 3, but it's something that's very important in the overall equation.
I want to go to the history side of things here in a bit, just because of some of the historical misconceptions and some of the laws and regulations that have changed. But while we're on this specific topic, let's talk a little bit about how does so you're 62, you have substantial equity in your house, you start going through the process of taking out a reverse mortgage. You can only take out a certain percentage of your mortgage, which is one of the law changes that's taken place over the years. Talk a little bit about, is that tax-free in terms of getting into your equity? And then we've also talked about, there's term payments, 10-year payments, a reverse line of credit. Kind of give a high level overview of the tax side of things, but also the different options or combinations of ways that you can get to the equity.
Yes, good question, Austin. So the first thing, excuse me, to be aware of is from a tax situation. And any good advisor like yourself is going to talk about taxes because it's not what you make, it's what you keep. A lot of people have said that.
Yep.
We found that out on our first paycheck when we thought we were making $300 and we only got 250. And I asked my dad, how come I only got 250? I had $300 worth of hours that I got paid on this job. And then he explained to me about taxes, and you don't get everything that you make. That's especially important in retirement. Wealthy people, that's the number one expense that they have in retirement, is taxes. For average people, the number one expense is housing. We affect both of those biggest single things that are going out because we reduce the cost of housing and turn housing into an income instead of an expense. So all of the money that comes out of a reverse mortgage is not subject to capital gains, is not subject to any taxation because you're not selling your house. It's borrowed money. So it's not a special loophole. Borrowed money is never taxable. If you borrow $30,000 to buy a car, you don't get taxed on that $30,000. So it also helps with taxes because I get a tax deduction. I saved personally over $34,000 last year in my personal taxes, like a lot of my clients have, because I had a reverse mortgage and I didn't need it, but it made sense to use with the rest of my planning. You can also use it for Roth conversions. So
Mm.
the bottom line is it helps with your taxes. It never hurts you with your taxes. It
Yeah.
can only help. Um,
What about
so
yeah, that's
go
very
ahead.
helpful. What about the different options, the different ways of getting to the equity?
Yeah, so it's a lot of things it's weird. It's kind of like one, two, three. In a lot of things with a reverse mortgage, there's three buckets and there's three ways to use a reverse. There's three types of client that will want a reverse mortgage when they turn 62. The first group are the people that have their house paid off, and they say, "Why would I want a mortgage? It's paid off. I'm done with mortgages." Well, yeah, but you're not done with using that asset. So we simply allow you to have access to the money inside your house. My mom and dad never used it until they needed long-term care later in life, and there was a big bunch there that they were able to use tax-free instead of pulling money out of their IRA because they were not able to qualify for long-term care insurance, and so they used it for long-term care funding. Hopefully, most of your clients will not use it for a sad thing like that. It'll be more of a fun thing, but you could pull money out for tax-free income. You can pull money out to buy a motorhome or to fix the roof or whatever the case may be. So that's the first group is we simply make money available inside your house to use for even things like paying taxes or paying people in Florida are taking it out to pay for insurance because their insurance bill went way up. So just simply making liquid the equity inside your house, even though you have it paid off without creating a payment. Because people say, well, I can just get a home equity loan. If you take $100,000 out in a home equity loan, you got to pay back 150 or 200, depending upon how long it takes. The second group were me, and this is the biggest group that can be helped the most with the reverse mortgage. The people that are over 62, you alluded to this earlier, Austin. The people that are, excuse me, over 62 that are still making mortgage payments need to stop in most cases because it doesn't make sense to continue sending money to bucket three, even taking money out of bucket two. I know some people that have specifically filed for Social Security just to make their mortgage payment, which is a big mistake because there's not a requirement to pull money out of bucket one, your Social Security, in order to make your mortgage payment. Some people can't quit working because they think they have to make a mortgage payment. It changes all of your plans with retirement if you know you don't have a mortgage payment. Because when my mortgage payment went from 2,800 to zero, it made a dramatic difference in my cash flow. It was a big deal. Even though I'm still working, I could afford to make a mortgage payment. I didn't want to. And I wanted to give that money to my advisor because I could accomplish far more in bucket two than in bucket three. So the people that are making mortgage payments, that is the smartest thing to simply say, I'm going to redirect those funds. I'm going to help my kids more. I'm going to give more. I'm going to travel more, whatever the situation is from that. The
Yeah,
third,
quick,
go ahead.
quick story on that before you get to the third bucket. So working with a client myself, having a review meeting, updating their financial plan and talking through things, getting ready for retirement over 62, didn't even bring up this concept, but simply just showed spending in retirement and expenses versus the income coming in, all that stuff. All I did was simply change what happens if you don't have a mortgage in retirement. And our software has what's called a Monte Carlo analysis that runs it through 1,000 different randomly generated sequences over historic years of inflation, rates of return, all that good stuff, of kicking out a probability of success, that what is the percentage or likelihood that you would or would not have to change your lifestyle in retirement. And for this example, by just eliminating the mortgage, not even talking about any of this, the plan went from 66% to 94%.
That's an excellent example. We've seen that many times, that it's the difference between success and failure. It's not just that it's a little bit better, it's whether or not you're going to make it or not. And that's so important on that second scenario of why are you making a payment? And, I often will show people this kind of cute little slide, because everybody knows it. This is one of my favorite snacks, and that's Cracker Jacks. There's a prize at the bottom of the box. And it's not just the peanuts and the popcorn, the caramel popcorn. It is that prize at the bottom of the box that you can flip back into a free retirement plan that you didn't even know you had. It is a powerful tool, and such a big difference in how that goes together. And we really want people to understand that. The third type of person,
Yeah.
you kind of alluded to, somebody that's going to live in their house long term. You should live in your house for more than 3 to 5 years. We don't give you a prepayment penalty, but there's costs involved with setting up a reverse mortgage that you don't want to do it for a year or two. You should be in the house
Yep.
at least 3 years. But many people are in the wrong house. And I was in the wrong house. We loved our home. We were in it for 30 years in Wisconsin, but all of our grandchildren were 3 hours away in Minneapolis. Houses were more expensive there. So I sold the house in Wisconsin and then came to the house in Minneapolis, which I would not have done if we didn't have a reverse mortgage, because I didn't want a payment until I was 95 and another 30-year mortgage. And it was a more expensive house because it's more expensive in Minneapolis area than it was in central Wisconsin. There are many people that are going to be listening to this recording and are on the call now that should be moving because they're in the wrong house. Either maybe they want to be on a golf course, maybe they want to be closer to their grandkids, maybe they need one level, maybe we need less maintenance, maybe they just want to move to the beach. Whatever the case may be, many people are in the wrong home, and because they do not understand the power of a reverse mortgage, they are not making the decision to buy the next house with a reverse mortgage. Most people don't even know. Most realtors don't know, Austin. Most financial advisors, other than yourself, don't know that you can buy a house with a reverse mortgage by just a significant down payment, and then we come with the rest of the money, and you have no payment for the rest of your life. It's
So
a powerful tool.
yeah, so Harlan, maybe just a quick example of that specifically, since you said a lot of people um, don't know that, aren't aware of it. And I know you literally just ended by giving a very quick example of a down payment. We come with the rest. Maybe walk through that just real
Sure.
briefly again.
Just had a client that was moving from Indiana, and in fact, to the Carolinas where their kids were for retirement. A lot of people retire in the Carolinas because they still want the Four Seasons a little bit,
And they have a paid off house.
and they have a paid off house. They walked away with $300,000. But they didn't know when they originally started looking, they were frustrated because they looked all over the Carolinas close to their kids, and they couldn't find anything that was decent for 300,000. It wasn't as nice as their house in Indiana, not even close. So they weren't making a move to something better. They're making a move to something worse. When they ran into a realtor that understood it down in the Carolinas, she said, "Hey, if you've got 300,000 and you're over 62, you only need that 300 to buy a $500,000 house." And they said, "I know, but we don't want a mortgage." And she said, "This is a mortgage that you don't have to pay." So they came with their 300,000 from their Indiana home. And then we came in to closing with 200,000. And now they have no mortgage payment for the rest of their life. And they're living in a $500,000 house with no maintenance, with close to a golf course and everything that they were looking for. And most important, close to their kids. This is something that is a very simple scenario, and more people should do, but they just don't know because they want to pay cash for a house. And why do they want to pay cash for a house? So they don't have a payment. And in
And we're
addition to
gonna
that, Austin, they also get a tax deduction now for the rest of their life because they have acquisition debt on that new purchase.
so the 300,000 came from the sale of their house. Where did the 200,000 come from that you guys bring to the table?
That's what we brought in the form of a reverse mortgage, just like we
Okay,
would bring a regular mortgage, except our mortgage has a zero payment. A regular
gotcha.
mortgage would have a $1,500, $1,800 a month payment. our payment is zero. So obviously they can accomplish the same thing as paying cash for the house without coming up with all that money. And worse yet, they went to their advisor and said, "Can we take out 200,000?" Well, he said, "You've only got five." So it doesn't make sense to take out 200 by the time you pay $50,000 worth of taxes. So they just gave up because it didn't make sense for them to take it out of bucket two.
Yep. Yep. No, I think those are three in terms of those specific buckets we just talked about. I think those all three of those are very helpful, make a lot of sense, especially I think we're really all three of them, but even that first one, as we know, a lot of people have mortgages going into retirement, but for that group of people that don't, I think it's easy to say, well, why do I need a reverse mortgage if my house is paid off? Why would I pay the cost for something I really don't need, especially if I take it out without having a specific need for it? And not really getting into the mechanics and the weeds of that. But I think it's nice to see a list of ways that it can be beneficial for people that don't have a mortgage to still consider a reverse mortgage, because I know the list that you have on that one PowerPoint slide isn't all of the options for people that don't have a mortgage.
Well, that's true. And I always challenge people when they say, "Well, I don't need a reverse mortgage." I said, you don't need a car either. You can ride a bicycle or a moped. You don't need a car. Well, yes, we need a car because we've got to go places at 60 miles an hour. And I said, well, a reverse mortgage just allows you to go a little bit faster and better in retirement. So it's not something you need. It's just something that enhances it. And I always ask people, and the answer is very quick: when is the best time to borrow money? And everybody knows when you don't need it. And that'll come out within seconds, no matter which group you're asking. And so make sure that that money is available. Because my dad asked me that. He said, "Harlan, we're small-time farmers. We don't need any money. We're doing fine. We're still saving money and we're in our 70s." And I said, "Well, Dad, you never know. A rainy day could come." And unfortunately, it did when Dad had his stroke, and needed a lot of money for home care to stay in his home. And so you always borrow money when you don't need it. And if you set that line of credit up, our lines of credit double every 10 years. And so if you start at 100,000, you got 200,000 at 65 to 75. At 85, you got 400,000. It just makes sense to start early so that you're
Yep.
prepared for the storms that could come with retirement or the fun opportunities.
Yep. And we're not going to be able to get obviously into a specific illustration or example, but your point there of basically the line of credit doubling, the only the cost associated for opening a reverse mortgage at a very high level is the closing cost. And then because it's a non-recourse loan, which I think we'll talk about here in a little bit, but basically any of the cost associated with taking out a reverse mortgage that comes from the equity portion of the reverse mortgage, and that's growing, what I've told people, in a negative way. That's a negative balance growing, but you're also having this line of credit growing at a positive way, like you just mentioned.
Exactly correct. People will say, "Well, what do I lose if I get a reverse mortgage?" And I said, "Well, I wouldn't call it losing. I'd call it spending. You spend money to eat, you spend money to fix your home, whatever. So what do you have to spend? Well, you have to spend somewhere between two, depending upon which county and state you're in,
Hmm.
somewhere between 3 and 4% of your equity. So if you got a $500,000 house, you give up, let's say, 20, somewhere in the neighborhood of $15,000, sometimes even $20,000, depending upon the taxes in on the closing costs in different states. So if I give up 2, 3% of my house in order to guarantee that I never have a payment for the rest of my life, I'd be happy to, quite frankly, to pay six. You pay six to sell your house, with most real estate fees. So
Yeah.
I give up a small percentage of my house in order to guarantee the use of the rest of the money. And quite frankly, houses fluctuate by 3 to 4% a year every year anyway.
Yep.
So you're kind of paying with air or with beads. It's not real money. You're giving up some equity. And that's where people get confused about the cost of some things. Yes, there's a higher cost, but I was thrilled to pay the cost because I didn't have to pay it. I didn't have to pull it out of my brokerage account or out of my checking account.
Yep.
It was
Just
just
coming
pulled
from the
out of the
pool of
value of the
equity
house.
that you, yep. Yeah, there's a lot of myths in retire or in reverse mortgages, and I want to, before we kind of go into rapid fire about the different myths, I want to go back to kind of the history of reverse mortgages. and we've kind of talked about some of them. There's a non-recourse loan. There's a counseling class that people have to take. Even if you have X amount of equity, you can only get to a percentage of it. And that's calculations, I think, behind the scenes based on age and value of home and different things like that. My point is, there's been some significant changes to this whole space over the last 30 years. I think even relatively significant changes in the last 10 to 15 years.
Mhm.
In our notes, we mentioned the 2013 Bennett versus Donovan case, but whether it's that or anything else for our listeners, at a high level, kind of talk through some of those changes in terms of what makes this a more favorable asset to consider now.
Yeah, excellent question. Somebody said to me, Harlan, you say these things are good, but where there's smoke, there's fire. Why is there so much negativity? All you have to do is utter the words reverse mortgage. I fly a lot and travel a lot. I'm taking off this afternoon, in fact. And invariably, I get on the plane with someone and I ask them where they're going and what they're doing and what do you do for a living and then they ask me. And I said, well, I specialize in training financial advisors and real estate agents and loan officers on reverse mortgages and the value they have in retirement. They almost always put their earpieces in or turn away. I don't want to sit next to this guy for 3 hours. Um, but usually at the end of the 3 hours or 2 hour trip, we've changed their thought process on reverse mortgages. And many of them say, well, what are they? I've never heard of that. What is it? Especially the younger people. So where there is smoke, there is fire. Yes, there were problems. In fact, they were horrible up to 1988. They ripped off thousands of people and kicked widows out of houses. I just did a segment on a podcast with Rob West on Christian Family Radio yesterday on
Yeah.
widows. Everybody, it hurt lots of widows. And that's what I thought. This is terrible for widows because they're the ones that are going to end up getting kicked out of their house because that happened in the early reverse mortgages and when the spouses were not protected. First of all, Reagan came in and fixed a lot of those things in the Housing Act of 1988. So a majority of those things were fixed because now they're federally regulated. Non-recourse came in, meaning if you live too long and the value of the house goes down, you can never be held accountable to pay any money except what's in the value of the house. My uncle died in 2009 in the housing crash. His $200,000 house was only worth $100,000 in the little town of Edgar, Wisconsin, population 450 or whatever. So his little house was now worth 100 and he owed 150. All of that was wiped away and his heirs owed nothing. And the 300,000 that he had with his advisor all went to the heirs. So
And they just had to sell the house at that point.
exactly, they sold the house
Of-
and they got a tax deduction when they sold the house because they claimed the interest that Uncle Arvid had never paid. So that non-recourse factor, if that was not in place, which happened in 1988 with Reagan, I would not sell these. I would advise everybody against them because you don't know how long you're going to live. And so this is a safety net that absolutely guarantees that nobody's going to get kicked out at any point in the future if the line crosses. But the other thing was the lawsuit that happened in 2013. There was a bunch of stupid men, and that's unfortunate that that happens, that took their wives off from title so that they could qualify because their wives were younger. And then they got the reverse mortgage and had a grand old time. And then they died and left the house and the mortgage to their wife, and their wife wasn't on title, and she got kicked out of the house. And it was awful. It was front page USA Today, ABC News with Diane Sawyer. It was awful. It looked terrible, and it was splashed all over the airwaves that they're kicking widows out of houses, which was not the fault of the reverse mortgage. It was fault of the men who took their wives off from title and didn't properly take care of things to protect their wives. So we said, well, we got to protect people against themselves. And so the rule changed with FHA and said, if you have a younger spouse, you cannot, and you're married to somebody that's younger, you cannot take them off title. And so that is exactly what happened. And now, for example, when I did my reverse mortgage, my wife was underage. She was 59. I was 62. She was part of the deal, part of the mortgage, part of the title. And if I die tomorrow, she can live in the house until she's 150, even though she was underage at the time the loan was done. So that has been fixed. But everybody who doesn't like reverse mortgages or who haven't been updated says the same thing. Oh, but the wives can get kicked out. That's a horrible thing to do because the wives will get kicked out at the end. There's federal government protection against that now, and that problem is gone. But it was an awful situation, an ugly chapter in our history, and it's been fixed. But unfortunately, people still talk about it, and that's one of the biggest issues. But interest rates are regulated by FHA. The loan to value is regulated by FHA. The counseling is regulated by FHA. All of our numbers and closing costs are regulated by FHA. So it is the most protected. Some people say reverse mortgages are a scam. Well, it's a federally protected scam then. I hate that word because it's associated with reverse mortgages a lot. And there are scams out there. There's still companies that are not reverse mortgages. They're called home equity agreements, HEAs. Those are dangerous. Those are just like the old style reverse mortgages before 1988. And you do lose equity in your house. You do lose control of your house and you are signing the deed over to somebody else.
Yeah.
That's a whole different deal than what we're talking about here.
I think going back to your point there of the person that passed away with the house decreasing in value and the beneficiaries or inheritance not passing through to who it was going to go to. I often think I hear that from people that I talk to about this is, well, we don't want to touch the home equity because the home is going to pass on to the kids, and we don't want to mess up that inheritance because it's tax free and we got a nice pool of equity there, and we don't want to give that up.
Thank you for bringing that up because that next to the fact that, we're going to get kicked out of the house, that is the single biggest thing that causes people not even to look at a reverse mortgage. I once stood outside a grocery store in Florida where we have our winter home, and I asked everybody that came out of the grocery store, "Hey, I got a quick little survey for you. Question number one: What are you going to do with your house when you die?" Instantly, everybody said, "We're going to give it to our kids." There was no, what color is the sky? It was an instant answer. However, the second question was, will your kids want it or will they sell it? What will they do with it? That was not answered quickly. It was like, well, honey, what do you think? Do you think Billy will move down here? Well, I don't know. Maybe Susie will. And they're still talking about when they're putting the groceries in their car because they've never really thought about that. Fully 98% of kids sell their parents' houses within 6 months after they die. They do not want their house. They want the money. If that's the case, why don't I put the money into bucket two? Because I have people say, well, you must not care about your kids. I care a lot about our four sons and our four daughter-in-laws and our seven grandkids. I love them and I care about them and I want to leave them an inheritance. But first of all, I want to give them money now to help them when they've got little kids and they need help with a lot of different things. I want to be in control of being able to help them now, just not leaving something when I'm 90 and they're 60, but they will still get an inheritance. I can afford to buy life insurance and I can afford to put money into Roth IRAs because I never paid off my house. When I look at my financial balance sheet, I owe money on my house. And the reason I owe money in the house is because I put more money into bucket two on purpose as part of a plan. And that's why people should start looking into this when they're in their 30s or 40s is, hey, I don't have to pay off my house, so I'm going to put more money into my brokerage accounts and into my planning accounts in bucket two. That is a far better inheritance. Is it bad to give your kids houses? No, that's fine because yes, there is a step up in basis, but we don't know the value of our house next year, say nothing about 30 years into the future. And there's a possibility the value of the house could go down and you die in a year like my Uncle Arvid, where houses plummeted by 20, 30, 40, 50%. And it's
Yeah.
much easier to control what I'm going to give them in an IRA or life insurance or a Roth than what I can in the house. And think about this. Anybody that came to you, Austin, would never think that it would be okay to put $500,000 into one stock. I bet nobody has ever walked into your office and said, I want to put 500,000, I'm going to put all my money into AT&T stock or into Nvidia or into Apple or whatever. They know that it should be diversified. But those same people think nothing of having $500,000 into one real estate stock called their house.
Yeah.
And you don't, so it's easier to give money to your kids because the kids can't all move in. Well, they could, but most of them don't, obviously. They're going to sell it so they can divide up the money. It's easier to divide up the accounts that are in bucket two. So people really need to think, how does this work with an inheritance? And Ron Blue has said at different times, you should be given while you're living so you're knowing where it's going. And I prefer to help my kids now, and I hope to give them a lot more while I'm alive first of all, so I can control it. Secondly, so I can see it. And I know where it's going and what it's doing for my children's and my grandchildren's best interest. And so people get confused that there's one guy actually told me, Austin, it's in the Bible that you should give your house to your kids. And I said, check it out again. Do a search on that because it's not. It talks about giving inheritances, but it does not talk that you should leave your house to your kids.
Hmm.
And yet it's almost an unwritten rule, Christian or secular, give your house to your kids. And that is not wrong. It's just very inefficient. Your accounts, your products in bucket two are far superior for inheritances as compared to bucket three.
Let's play the myth game here. So we've talked about what a reverse mortgage is, opportunities of ways to use it. We've talked about the historical nature of it and laws and regulations that have changed. So let's do a rapid fire here, myth versus fact, and I'll say the myth, and then you can kind of come back with the fact here, and we'll yeah,
Sounds
time's
good.
flying when we're having fun as we kind of get in these last 10 to 15 minutes before we open for some questions here, because there are some other questions I want to get to, but let's just say, hey, myth number one, the bank will own my home if I do a
It,
reverse mortgage.
Yeah, at Movement Mortgage, I always tell people we are lenders. We are not landlords. We have no interest in owning your house. If we own your house, something went wrong. We had to foreclose. We have no ownership in your house. We are a lender. We put a lien on your property just like we would with a home equity loan, just like we would with anything else, so that we can collect what is owed to us at the end and only what is owed to us. If you owe us 100,000 and your house went up to 1 million, you only owe us 100,000. We have no ownership interest in any equity, only collecting the interest on the money that we gave you.
Some of these we've talked about, but myth number two, my heirs will be liable if I owe more than the house is worth.
Yes, you can only win. I'm going out to my next program that I need to do tomorrow is in Las Vegas, and there's a bunch of casinos out there, and I'm not big on gambling, but if there was a casino out there that said you are guaranteed only to win, you cannot lose. Even though I'm not into gambling, I'd go into that casino because you can't lose. That's the way we've set it up. You are guaranteed heirs not to lose. You can only win. If there's money left over, you get all of it. If the house goes down in value and your mom and dad live too long, you may get nothing, but you are guaranteed never to pay the difference. You can only win.
Myth number three, access to my home equity can be frozen or shut off during a disaster.
Well, there's an element of truth there because if it's a regular forward mortgage, a regular line of credit, whether it's with a big Bank of America, Wells Fargo, or if it's with the local corner bank, every line of credit, including ours, not the reverse one, but including movement mortgage regular loans, all loans can be frozen or cut off on the line of credit if the value of your house goes down, your credit changes, somebody dies, somebody gets sick, whatever the case may be. And there's a line in every one of them legally that says if we deem ourselves insecure, we can close your line or ask for full repayment. Most people don't know that. They just think that it's available, but many people remember it being canceled in the market crash in the housing crash in 2008. Reverse mortgages guaranteed never to be taken away as long as you live in the house, as long as you're alive, and you make the payment on the taxes and insurance. If those things are taken care of, your line of credit isn't only guaranteed, it's guaranteed to go up even if the value of your house goes down. There was some clients that we had in California, the wildfires. Their home was decimated. There was nothing but ashes. They could still draw on their line of credit. Same thing with the people in Florida with hurricanes. A reverse mortgage line of credit is non-recourse and cannot be taken away by federal law, no matter what happens to you or the value of your house.
Yeah, that was an educational point for me when I started getting into this more in terms of the traditional home equity line of credit without the reverse mortgage. But if I were just to go say, hey, I want a home equity line of credit on the equity in my home, that could be frozen or shut off. Yeah, I did not know that. So that's maybe educational for other people as well. But the last myth here, it's better to wait.
Yes,
Because we know we said we
that's
could start at 62, but it's better to wait.
yeah, so many people say that. And they even say that in your business when they're saving. Well, I'll put more money away when I get to my 30s. In my 20s, I'm going to have fun. And of course, you can show them the reason why they should start saving in their 20s because they could never get that
Compound
compounding.
interest. Yep.
Uh, and so, same thing with a reverse mortgage. The quicker that you eliminate your payment, I just talked to a couple in Columbus, Ohio, and they're 78, and they had heard our program on FaithFi a few weeks ago. And they said, why didn't somebody tell us about this earlier? How come our financial advisor didn't tell us about this? How come our mortgage guy didn't tell us about this? Because we're 78. We could have done this at 62. We've
Mhm.
been paying on this for a long time and not having a good retirement fund time because we always were worried about making that mortgage payment. And we didn't realize that we could take it to zero way back when we were 62, more than 10 years ago. It never makes sense to wait to start the line of credit because the line of credit starts going up with compound interest. At 62, it's 100,000. At 72, it's 200,000. At 82, it's 400,000. 92, if you have a long-term care event, it's 800,000. It just keeps going up. So you should not wait, get that started right away. If you are making a payment, you should not wait because you should stop that payment as quickly as possible so you're taking less money out of bucket two or putting more in because you already know on your software when it went from 60 some percent to 94%, simply eliminating the mortgage payment and doing nothing more. The quicker you eliminate the mortgage payment, the more effective and more powerful bucket two is because you're not going to kill the goose that laid the golden egg in bucket two. And if you're moving, the quicker you move, the better. I moved at 60 and then did my reverse mortgage at 62 because this is where I was going to be long term. The quicker you buy a house with a reverse mortgage, refinance your existing house, the numbers will bear it out every time. You don't wait till your car is smoking on the side of the road before you take it in for service. Nobody would do that. You don't wait until it's last resort and you're broke before you do that. You
Well, that,
can. We'll help people at that point, but we
yeah.
don't want to just come in and be the white knight at 92 years old. We'd rather help you at 62.
Yeah. You just gave an example kind of that there at the end, what you just said in terms of the last resort. But two questions I have here before we maybe answer some questions, but can you elaborate a little bit more on what you just said in terms of people that think that this home equity line of credit or reversed the line of credit reverse mortgage is a last resort, meaning you've exhausted all other opportunities, you're down to social security or a pension and a pension, or your assets are you're using them. Now I should consider a reverse mortgage as a last resort.
Yeah, that's a conventional wisdom because that's what a lot of people have told them. Financial advisors that don't do the digging in the rabbit hole, as you mentioned earlier, have told them. Dave Ramsey has told them. Susie Orman, their brother-in-law, has told them. A friend has told them. Yeah, you don't get those until you're broke. When you're broke, then you look into it. So there's an overwhelming thought process that that's when you do it. When in reality, if you look at the math, you win every time when you do it earlier. It's not wrong to do it at 92. We just did one for a lady that's got a $3 million house in Long Island, New York, that was literally broke. And now she's healthy and now she can fix her roof and live in her neighborhood. And she thought she had to sell her house. So we can certainly do that and we can come in and save that 92-year-old widow, but it would have been a lot better and her retirement would have been better if we would have done it at 62 instead of waiting until 92. In every case, I always tell people, just prove it to me. Try to prove to me why you should wait, and I'll come back with the numbers. And that's what our team does is simply lay out the numbers. If you wait, this is the cost of waiting. When somebody says, well, I'm not going to make a decision yet. Well, yeah, you've already made a decision not to do it. So you've made a decision to forego the reverse mortgage benefits for another 5 years. That's a decision that is going to go against you for many years into the future. So I encourage everybody on this call, everybody that's listening to the recording, just check into it and find out why. On my business card, I've got a statement that says, if what you thought you knew about reverse mortgages and money was wrong, when would you want to know? Nobody's ever said to me, well, tell me in 5 years. They say, well, I want to know. I don't think I'm wrong, but I want to know right now. You should find out and look at Austin software and say, what if I eliminate my mortgage payment today rather than waiting 5 years or until I quit my job or whatever? What will happen if I start taking tax-free distributions? When Austin run those numbers, that's what you want to look at as to the fact. What if I take less money out of my investment account? What will happen to my investment account? We've seen differences even in $1 million account of being $1 million difference, or a $500,000 account being 500,000 difference in their mid to late 80s.
Mm,
So the quicker you do it, the
mm,
math will prove out. And that's just look at the math. Somebody said to me once, I don't believe in reverse mortgages. And I said, well, this is not a faith-based product, it's a math-based product. You don't have to believe in it, just look at the math. And then so few people do that because they just have heard, oh, yeah, they're bad. I'll wait till I'm broke. And I hope I never have to do it. And in fact, some people are apologetic about it and say, I never thought I'd have to do this, but I think I'm going to need a reverse mortgage. Well, that's just the wrong attitude. That's like saying, I never thought I'd have to do it, but now I got to take Social Security. Well, most people say, I get to take Social Security now between 62
true.
and 70. So that's really the situation of the earlier planning is always going to win out in the end. But I don't want to disappoint people that are on this call that are in their 70s or 80s. Somebody came up to me and said, well, I missed the boat. I'm 75, so there's no sense in me doing it. It still makes sense to do it. Just don't wait until you're 85 now. Take advantage of what you have available to you right now.
Last question here is twofold. Stewardship. We hear a lot about stewardship, managing what really isn't ours of what we've been blessed with. Saw you down at the Kingdom Advisors Conference. And I'm sure you have generosity stories from people that have done reverse mortgages and had the line of credit. And so the twofold question is talk a little bit about movement mortgages, financial stewardship, and kind of your value proposition when it comes to that. And then quickly, if you could maybe share a story or an example of how you have seen generosity play out when it comes to having a reverse mortgage.
Well, thank you for that. We tell everybody, somebody came to me once and said, I know Movement Mortgage is all Christian oriented. You guys have a foundation. You build schools for underprivileged children. And I'm not a Christian. Am I going to be comfortable being a client of yours? I'm just asking you point blank, they said to me. And I said, we use Christian principles to help everyone, whether you're an atheist or whether you're a Muslim or whatever your belief system is. In fact, one person on our team is Jewish. The Christian principles work, biblical principles work, whether you believe them or not. It's kind of like gravity. And so we're going to use those Christian principles and we're going to tell you why we're using them. And you don't have to be a Christian to benefit from them. And so that's really what we look at is the three S's. Stewardship is number one. Why should you bury your home equity in the ground when you can do something with it?
Mm,
A client of mine said, well, I'm going to give my house to my church, so I really don't want to do a reverse mortgage. And I said, does your church have any needs right now? And he said, yes. As a matter of fact, if we're building an unwed mother shelter in my town, and I've already pledged my house for to keep that going. And I said, how old are you? And he said, 65. And I said, are you in good health? And he said, yeah. I said, what if you live to be 85? How many unwed mothers need to be helped in the next 20 years? And he said, there's a wealthy person in our church that has done a match. If I can get $100,000 out of my house, I can get 200,000 that goes into this unwed mother shelter. Because of that one decision, that unwed mother shelter was built 3 years early and has already been helping a ton of unwed mothers have babies that otherwise were considering abortions. So the issue is what can we accomplish right now with
mm,
that money from a stewardship standpoint? So we look at what is stewardship, the three S's, what's smart, what is the smartest way to do it, because there's a number of ways to do things, and what's the safest way to do things. The safest way to do things is not to have a mortgage that requires a payment. The smartest thing to do is to leverage bucket two and do more with it. And from a stewardship standpoint, whether you're just doing it for a better standard of living and a better retirement, or you're helping your kids, you're helping your grandkids, or you're helping your church or your charity, that's a scenario that everybody can feel good about, whether they are strictly Christian based or not. At Movement, we give to causes that are not specifically Christian, but we do a lot of things with churches in Central America. We have helped thousands, literally, of children that are in disadvantaged areas to be able to help them. We give away half of our profits. And so far in 15 years that we've been in existence, we've given away $400 million. Our CEO, our founder, does not live in a fancy house, does not take big salaries, drives around in a used pickup truck, and has given away $400 million. So you can be assured that when you're dealing with us, not only are you getting a good deal on a loan and we're taking good care of you, those profits are also going to help those that are a whole lot less fortunate than you. And you can do it even in your own situation. Why not take some money out of your house and give it away? Because the only thing we know for sure is we can't take it with us.
Yeah.
And so what are we going to do with the house when we're
We
gone?
can't take it with us, and we don't know how long we're here. And
That
so
is
I
so
think that's
true.
just that's another great example of, what you were saying about your kids, and you'd rather help them now rather than pass away at 90 and they get something at 60 and you don't really get to see that legacy lived out. I think that's very true with the example you just used in terms of the shelter for the women and kids. And yeah, that's great. Well, Harlan, thank you very much for your time. Again, I know you've got a lot going on, and I know you said you're getting ready to go on a flight here. But thank you very much for this time to, again, the main goal was to educate people, hopefully, whether they're on here or listening to the recording, that they feel a little bit more educated to the level of maybe prompting some questions to ask further down the road here. And so we do want to leave just some space here. If there are any questions, we're going to be kind of short on time in terms of how many questions we can ask. You can see, hopefully, on the screen here, Harlan's email address. If there's any questions that you would rather, if we run out of time, or just simply would rather ask via email rather than on the webinar here, feel free to do that. But you can see all that information up there for Harlan as well, and him or myself will figure that out and get back to you. So. Harlan, I don't know if people can just unmute themselves or whatnot, but Harlan, maybe you also want to talk about what we've got going on here with the QR code.
Yes, two things. First of all, if you'd like a copy of my book, you're welcome to get it for free, and we'll ship it to you if you simply send me an email or go on that QR code and fill out the info on our website. Because we want to help educate you on that, and then, but don't stop there. Say, I want to know. I spent an hour listening, but I don't know how this fits with me. Between Austin and our team, I don't personally do the loans. You'll be working with one of our RMPs, retirement mortgage professionals. Jill Shepler is the one of the main people that you will talk to. But we'll go through this with you and give you your different options of what's there. And if you just hit the QR code from there, because a lot of the questions you may ask are personal. The other thing I wanted to say, though, is most of our loans we do with financial advisors that we have vetted that we feel comfortable with. I've talked to thousands of financial advisors over the last 20 years. Austin and his firm are unique in the way that they do things. And you're fortunate that you're dealing with him already, or if you're thinking about looking at working with a financial advisor, because any financial advisor that does not understand the power of trillions of dollars of home equity and how it works, what else don't they know? Austin is not somebody that thinks he knows it all and doesn't need to be taught anything. He's asked us tons of questions, went over things even with personal family members. Without question, you are in good hands with Austin, and we work together with Austin and his team to make sure that the best outcome. I come from a medical community, and if there's 2 or 3 doctors that are working on a difficult problem, they can accomplish more than one person.
Yeah.
That's what we do here is multiple physicians
Yeah.
for your money.
It's all
And
about the team. Yep.
that's the key. And so I know I ran up right up against the time. So send your questions over. We didn't have a chance. Hopefully, we answered a lot of your questions. And thank you for spending the time with us. Certainly, we look forward to changing your life for retirement for the better. And we just appreciate the opportunity. Thank you, Austin, for
All
giving
right.
me
Yep.
this opportunity.
Yep. Thank you. And thanks everybody for joining us and listening to hopefully the recording as well. So thanks, Harlan. Safe flight.
Thank you very much. Talk to you soon.
Take
Bye
care.
now.